So welcome to another session. This is session 2 of the Startup Money Playbook that we actually started the first day yesterday. And so today we are going to study about revenue, profit, and cash in depth. This session is all about, what goes on in profit and loss, every line, right? And gross margin versus net margin, why margins beat revenue, then study AI, the example that we actually saw. It's a profit and loss. We're going to build it live. So we'll see how that is. And the 5-minute P&L check, right? While the session has been designed for 1 hour, I'll try to wrap it up in the next 20, 25, 30 minutes, maybe. Right. So let's get started. Yeah. So as usual, these are the 6 pointers that we've already covered in the earlier slide. So quick recap, first of all, for the first 60 seconds, and then we'll talk about the profit and loss statement, how it starts from revenue, then COGS, then gross profit, operating expenses, EBITDA, net profit, and then slowly and gradually we'll talk about the 5-minute, P&L check. Okay. So 60 minutes, 60 seconds recap, what you already know. Yesterday, we saw that money is a teachable skill. It's a learnable skill. And it's absolutely not at all a talent, which means anybody at any point in time can learn. The second lesson that we learned was revenue is not the profit. And of course, profit is not the cash. And it's the cash which is really important. And that's the ultimate thing. These are 3 different numbers. And if you get confused, it's going to kill your business. The next one, the 5 money mistakes. So never get confused between cash or revenue. We saw about, having no margins, right? Obviously, because you'll always get, stuck. Spending tax money, that was also another problem. There's no runway, that was also another problem. And one thinking, right? And if you may recall, there was a homework, there was a kind of thing that you have to do for the next 4 weeks, starting every Monday. Okay, open your bank account and write those 3 numbers. Okay, first one is whatever the number is there, the cash there, write it down. And the second column, the third column, you to mention the money in and the money out over 1 week. Every Monday, give it 5 minutes. Part 1 of today's session, it's all about the profit and loss statement. Very common. Everybody sees this, right? And we are going to talk about profit and loss without any jargons. Okay, so yesterday we saw what revenue is. Revenue is the total money that you generate by selling your products, your services, right? Nothing else. Okay, so what P&L actually contains is, it starts from revenue, then obviously it has something called cost of goods sold, whatever cost that is incurred in making that whole product. And when you subtract the COGS from the revenue, you're going to get something called gross profit. Don't feel very happy, right? Gross profit is profit. It has to be positive and it has to definitely have enough margins. Now, how do you calculate margin? That's the question. Okay, so very simple: revenue minus COGS divided by revenue multiplied by 100. That's the formula. Okay, and then after that, there are some more expenses, operating expenses, the day-to-day expenses. Okay, it could be electricity bill, it could be travel, it could be marketing, right? And what you get is your earning, but that is before interest, taxes, depreciation, and amortization, right? And then when you subtract depreciation from EBITDA, you get something called EBIT. And then if you remove the interest, you get something called PBT, right? Profit before taxes. And when you remove the taxes, you get the net profit. This is the take home money. And this is what you have been hearing, you have been seeing on Shark Tank when investors talk about what is the money that's left on your bank account end of the day. And it has to be really, really good profit, okay, to make your business model of your venture look healthier, right? So let's understand, right? What is a P&L statement and why it exists? The one sentence definition of a P&L, it's sometimes also called the income statement. right? It shows every rupee your business earned and every rupee it actually spent over a specific period. So therefore, when you see a profit and loss statement, you will actually see for 6 months or 1 year. Ideally, the best way is to create it for 1 year, right? And there's also something which is called what is leftover. That leftover will decide whether you have profit. If it is negative, then it's of course a loss. So it is the story of your business performance over a time. It's not at all a snapshot. It's a whole story for the entire 1 year or 6 months. Okay. So time period is very important. A P&L covers a period. Okay. Always observe for a month, quarterly, or annual. A balance sheet, on the other hand, is a snapshot. It's like a photograph. A photograph may look beautiful, but it does not tell you the whole story, the journey, the video, right? That is expressed, that is explained by profit and loss statement. So P&L is like a movie. Okay. A P&L records revenue whenever it is earned, not when cash is collected. So don't get confused. So you may offer a service or a product, right? And your consumer or customer has actually bought it. Okay. They may pay money, they may not pay money, which means they will pay money maybe after 30 days, after 45 days, after 60 days, sometimes after 90 days. Okay. But the moment you have given them, the agreement has been done, the invoice has been raised. Okay. The revenue, on in profit and loss, you'll have to record that. So revenue is earned actually. That is why P&L, right, profit is not equal to cash in the bank. Okay. Then there's something called the bottom line. Every business lives or dies by the net profit, or it's also called the PAT, that is profit, after tax, right? PAT. What you saw earlier was PBTA, right? And when you remove the tax, then obviously it is PAT. So this is the number on which tax is calculated. Okay. So who uses profit and loss statement? Founders track the performance, investors assess viability of your business, then banks decide loans based on this, and tax authorities calculate dues, and the board, okay, the board of directors make decisions based on this. And every business wants this to be profitable. So let's see. I also said that every line we are going to discuss. So on the top in the Excel sheet, right, you will have revenue. All money received from customers for products or services, total sales, nothing else. You sell 100 t-shirts for 400 rupees, 100 multiplied by 400. Okay, 40,000 rupees. That's it. But when you subtract, that's the second line, that's called the cost of goods sold. Okay, sometimes if you're selling services, it could be COS or cost of services, but let's keep it simple, COGS, cost of goods sold. It's the direct cost to deliver the product. It could be the material involved or the raw materials in making that product, payment gateway, fees, delivery, all that. Okay, these are variables, please understand. And when you subtract COGS from revenue, what you get is called gross profit. So revenue minus COGS is the gross profit, and this is the foundation of business. Okay. And when you subtract something called the operating expenses, which could be fixed, it could be semi-fixed costs. So fixed means, let's say, the rent. Okay. And you're paying some 30,000 rupees per month for certain square feet in a metropolitan city. It is actually fixed. You don't change. Electricity. Okay. Electricity bills will come every month, but that also depends on the consumption. Okay. So this is kind of, variable or semi-fixed. Salaries, right? Suppose after 5 months somebody leaves, obviously, and you're not filling that position, you can actually save that amount. So salaries are also fixed, sometimes not fixed. Okay. But you have to pay. Marketing, it depends, right? Then there are certain tools that you might have purchased. Okay. Then professional fees. So overall, we will call it as fixed cost. This we know that every month there is an expense of 2 lakh rupees. Okay. So when you subtract operating expenses or OPEX, sometimes it's also called the overhead. You must have heard this term, overhead. And if you subtract this from the gross profit, you're going to get something called EBITDA. In short, we call it as EBITDA, which means earnings before interest, tax, depreciation, and amortization. This is also called the operational profitability. Okay. And when you subtract from EBITDA the depreciation and amortization, okay, and these two things are actually non-cash, right? And they spread asset cost over useful life, right? No cash leaves in this line, right? So depreciation is usually for any kind of asset that you might have purchased. So let's say to start your business, you purchased a laptop, which is like 1 lakh rupees. Okay. And the next year, okay, its value will get reduced. Why its value will? Because the innovation in the technology of laptop is really very fast. Okay. So the value of your laptop will then be reduced by 40%. So if somebody has to buy, it will be 60,000 rupees. Okay. And let's say the life of the laptop is for 3 years. So you have to actually divide that value for 3 years and subtract it over a period of time. Okay. We'll discuss more on depreciation, but this is what it is. Right. And now when you remove your depreciation and amortization, D&A got subtracted from EBITDA, you get EBIT, right, which is the operating profit. This is called the operating profit, earnings before interest and taxes. And when you remove the interest component, right, uh, now question is, why do we need to have the interest component? Suppose you might have taken a loan from a bank or from somebody else at a certain percentage. There's an interest component that you have to actually pay. So this interest is part of the P&L statement. The principal is not the part of this statement. It is a part of the cash flow statement, which we will talk later. Okay. So you can also call it as cost of debt, right? Or overdrafts or credit limits. Suppose you have not taken this line will be empty. It's as simple as that. Once you subtract interest from EBIT, what you get is the PBT. This is the profit before tax. Okay. Or earnings before tax, whatever. What the business earned before paying income taxes. And you have to pay taxes, of course. And those are corporate tax, can be at, let's say, 25.17% effective rate, whatever for private limited companies, right? And what you get at the end is the net profit. This is the take home. This is what the business has truly earned. And this money, the net profit, is then further distributed among its shareholders, among its investors, among its, uh, the founders, everybody who's there on the cap table, depending on the percentage of the equity that they have. Okay. So one question, suppose there are 5 founders, or right. And of course, let's say there are 2 founders and 3 of them are employees, and all of them are actually taking salaries. Right. Where will salaries be accounted? Salaries will be accounted as part of your operating expenses. Okay. So let's move to the next. Hope this is clear. Yes. Recall Aryan. So let me refresh your memory. Aryan is from Jaipur. That's what we discussed. He started an app called Study AI. He is perhaps of the age of 17, 12th class, and what he's selling is CBSE notes, right? So his first month earning, and he started with 10,000 rupees, if you can just recall, right? So started in April 2025, let's assume, 200 downloads sold, selling price each at 99 rupees. And of course, if somebody is downloading, they're paying through a payment gateway. It could be Razorpay, it could be PayU, it could be anything, right? Let's assume 2% because that's how the normal rates are, right? And then the monthly hosting, because how will people buy? Where is this app getting hosted? There's a monthly hosting fee that he has to pay for, so 500 rupees. Let's assume there's a content creation he might have done himself or taken some AI tool or anything, or maybe some intern, somebody else might have helped. And let's say the cost that got incurred in creating that is rupee 1,000. Then Instagram ads, of course, because how will you get 200 downloads? Somebody should know, the customer should know. So he has created Instagram ads and did some marketing through that, advertisement through that, 4,000 rupees got in making that Instagram ads or running that. Then there are some software tools, 800 rupees. Then there could be some miscellaneous expenses, 200 rupees. And in Aryan's case, there's no salary, there are no loans. Very simple. On the right hand side, what you actually see is very simple math. 200 units multiplied by 99, that's the revenue, 19,800 rupees. Let's subtract the COGS. Okay, so 2% of 19,800, for every download there's 2%. So let's do it for 19,800. It's going to be 396. Content creation, which is amortized. Amortized means you can divide, right? So there's a huge amount, maybe it could be 8,000, it could be 10,000, but for 1 month it is 1,000 rupees. You can actually do that. So 1,000 is what is subtracted. What he gets the gross profit is 18,404. This is the 92.9% gross margin. How do you calculate? Very simple. Take the gross profit, which is 18,404, divided by the revenue, that's 19,800, multiplied by 100, 92.9. So the formula is very simple. Revenue minus COGS divided by revenue. That's it for gross margin. Very high percentage, good. So from here, there's a learning that digital businesses really fly high, okay, as long as they are giving value, right? They reach faster through Instagram ads, through hosting, several other things. Okay, but Instagram, hosting, software tools, miscellaneous, all these are additional expenses that he incurred. And if you subtract these 4,500, 800, 200, right, from 18,404, what you get is the EBITDA. That is 12,904. Much better number now, right? Because a lot have been subtracted. And the good news for Aryan is there's no depreciation because there is no asset, so zero. There's no interest because he has not taken any loan, right? So, and of course, because he has not taken any loan, there's no income tax right now currently. So the net profit is 9,656. So you may ask, why has he not paid the taxes? Because he does not come into that income tax bracket. Okay, it's a very small amount. Okay, good for a kid at an age of 17, 9,656, right? Closer to, I think, 50% profit. How do I calculate? Simple, right? I take 9,656 divided by 19,800 multiplied by 100. Good. Let's move further. I've already explained to you, so therefore this slide is really amazing. So what does gross margin actually tell you? So gross margin divided by revenue into 100 is the gross margin. That's how we actually calculate. Gross profit divided by revenue into 100. This actually tells the fundamental economics, right, of your product before overhead, before the operating expenses. A very high gross margin means every sale generates strong surplus to cover costs. Okay. On the other hand, if you look at the net margin, which is like a take home, assuming net, so this is net profit divided by revenue into 100. This is the bottom line. Now, why do we call bottom line? Because revenue sits at the top, so therefore it's called top line. I also said that revenue is called the sales, and net profit is at the bottom, so therefore it's bottom line. So the bottom line profitability after everything, that is COGS, OPEX, depreciation, interest and tax. By the way, this is not the minus sign. This is an explanation of everything. Okay, that hyphen. So what everything is the COGS, OPEX, depreciation, interest and tax. This is what you actually keep from every rupee of revenue. Okay, so in case of study AI, it's very simple. It's, I said, closer to 50%, which is 48.8% that you actually see. Now there are some industry gross margin benchmarks. Okay, and this will help you decide which industry actually makes a lot of profit or how it actually works. Take an example of a SaaS product, for example, software as a service, because it's completely digital. The investment is on the human brains, and today a lot of AI is coming into picture, right? So you invest a lot in salaries and hiring people, But once the product is there, it's all about sales. Okay. And it's about hosting, it's about cloud. So 70 to 90%, right? And that's why IT industry in India has really made India proud over the past 35, 40 years, if you actually see. Look at the edtech platforms, 60 to 80%, much closer to the digital. So edtech platforms also do that. Then we have e-commerce. Now on e-commerce, the investment is obviously on the in making that platform, but then it depends on which good is being sold, right? So therefore the profits then get reduced. It's 25 to 45%, still good. In case of manufacturing, right, because physical labor and everything is actually required, so 30 to 50%. In terms of restaurant food, the gross profit is quite high, 60 to 75%, which means the making cost, but the the net profit is quite less, 5 to 15%. So you can decide whether it's a sustainable business or not, because you have to actually focus a lot in terms of making good profits, right? And that's how it is. Let's move to the next. So the big insight that we actually learn is margins beat revenues, and that's every time. Take an example of two companies, two businesses. Business A, which generates a revenue of 100 crore rupees at 2% margin, and this is worth less than a 10 crore business, which means the revenue is just 1/10 of A at 60% margin. And the reason is very simple. You have now learned the math. For business A, if the revenue is 100 crores, let's say the gross margin is 12%. So 12% of the 100 crore, if you take, you're going to get 12 crore, right? Very simple. And operating expenses, 9 crore rupees. So net margin is 2%, which is 2 crores. On the other hand, if you look at business B, which is the clear winner, 1/10 of the revenue of business A, 10 crores. So you may say, oh, revenue is so less, sales less. No. Look at the gross margin. Gross margin is very high. Instead of 12%, it's 75% here. So the gross profit is 7 crore, 50 lakh rupees, right? Operating expenses, 1 crore 50 lakh. So net margin is 60%. Net profit is 6 crore, which is 3 times that of business A. Okay. So what kind of businesses? Business A, again, large FMCG distributor, fast moving consumer goods. Take an example of a toothpaste, toothbrush, right? Or a soap. So what this means is, this means you earn in business A rupee 2 for every 100 rupee of sales. But on the other hand, if you have a business like business B, you're going to earn 60 rupees for every 100 rupees of sales. The choice is yours. Okay, very simple. So we have actually summarized. So let's do that. High margin is equal to more cash for growth. Business B keeps rupees 60 from every 100 rupees earned. Business A keeps rupee 2. B can reinvest, hire and expand without needing more revenue. High margin also means higher valuation. Okay, so investors value companies as a multiple of revenue or profit. A 60% net margin business commands 10 to 20% revenue multiple. Okay, we'll talk more about valuation, but this is just one insight. A 2% business gets just 0.3 to 0.5 times. Same 10 crore revenue is widely different valuations. High margin also means you will survive the downturns whenever there's a problem. There's some kind of dearth, right? You're dependent on some kind of raw material, but you're not going to get. But if you're into a business which is really really of high margin, you can actually survive that. Okay, a lot of edtech companies survived in COVID. In fact, they excelled, many of them. So when revenue drops 30%, business A loses everything. 2% margin can't absorb a hit. Business B still has 30% net margin. Margin is your financial immune system. Low margin, you're trapped on the treadmill. Business A must keep selling more and more to get profit. They need 3 times revenue to match business B's current profit. They're exhausted. Margin gives you options. So let us look at the margins, right, of Study AI from month 1 to month 6. The revenue in month 1 was 19,800, and by the time it was month 6, the revenue was 1,18,800, closer to 6 times. So if you look at the gross margin from 92.96%, it actually increased to 97.1%. And the net margin also, which is 48.8% at in month 1, first month, it actually increased to 57.4%. Okay. So how does this happen? So gross margin rises from 92.9% to 97.1% because the revenue scaled. Okay. More downloads actually happened. This is the operating leverage. Okay. And this operating leverage, which is fixed costs, hosting tools, they stay flat. Right. So while the sales are increasing, but the operating expenses are flat, there's no increase in that. Okay. This is the digital product advantage. Right. I hope now you will have a fair idea to read any P&L in 5 minutes. Very simple. So the 5-minute P&L check, 5 questions in sequence. First question that maybe as an investor you may ask or as a founder, is revenue growing month on month? Very simple. Let's assume 10%. No growth is equal to stagnant or dying business. So look for consistent MOM increase. Flat or declining revenue means nothing is happening. You'll have to do something, do some pivoting, do some changes. Question number 2, is gross margin above the industry benchmark? If gross margin is rising, great. This tells you the fundamental unit economics. Below 40%, very hard to build a profitable business. If you remember session 1, there was Priya's restaurant example. Okay. There was also another example where the restaurant owner did not realize the gross margin. It was actually 35%. Okay. So much below. So obviously he will get, hit hard. Gross margin falling as revenue grows. Very simple. The third question is operating expense growing slower than gross profit? And this is operating leverage. If operating expense grows at 20%, while gross profit grows at 40%, margin expand. Gross profit growing faster than operating expense. Operating expense outpacing, revenue growth. Very simple. I mean, if you're earning less, if you're generating, less revenue compared to your fixed operating expenses, which is much higher, then the business is going to be, dead very soon. Is there a positive and growing net profit? There's a question that you should ask. So net margin improving, each quarter is a healthier sign, right? So this is not required for all early stage startups, but trajectory must be towards profitability. And net margin declining, despite the revenue growth, there's something wrong. The business, you might have to pivot, or I don't know, you have to stop. Okay, rethink about it. The last question is, does the net profit match cash from operations? CFO net profit, right? Ratio above 80%. So we'll talk about the ratios. This has to be about 80%. So if profit and loss profit is high, but cash is actually low, someone isn't paying. This cross-check requires the cash flow statement. So you have to also match your P&L with your cash flow, right? There has to be enough cash. So high profit and loss profit means and negative cash flow. This is not going to survive. So these are the 5 questions, the 5-minute P&L check for survival. Okay. So here is the thing. Revenue growing MOM? Yes. Very simple. So 40% average, pass. Gross margin above benchmark, 97.1, exceptionally. SaaS benchmark is 70%, rising with scale, pass. Operating expense growing slower than gross profit, just see, because if it was more, if it was higher, it would have been failed. So gross profit grew 6.3 times while operating expense grew 3.2 times only. Significant operating leverage. Okay, so you get an advantage, right? And pass. Then net profit positive and growing, pass. 68.181 in month 6 versus rupee 9,656 month 1. Net margin is 57.4%. Cash profitable since month 5, pass. And net profit matches cash from operations. Okay. So if you look at the CFO to net profit, which is 98.1%, and there are no receivables, right? Risk, which means you don't have to be dependent on the money that's going to come in the next month or after that. So this also pass. Test yourself. Very simple. 3 questions to look in the learning, right? And you can take. I believe you can pause the video, check your answers, and you will come to know. What you learned in this hour, very simple. The profit and loss statement tells the story of performance over time. Gross margin is the fundamental unit, economics test. Net margin is what you actually keep. Margin beats revenue, always, everywhere. The 5-question framework works on any P&L. Your action is very simple. Calculate your own gross margin today. Okay. Session 3 is all about the cash flow, where money really goes, right? And we're going to deep dive into operating, investing, financing, the CFO to net profit ratio. And of course, we'll take the example of study AI. Session 2 is complete from my side. Thank you for watching this. Do add your comments, like and subscribe. Take care.